Hello everyone, my name is Alexi and here on this video I'm going to speak about the 5 stocks that I recommend buying for May 2021. First one being Etsy, and if you never heard about Etsy, well, let me quickly explain you what it's all about. Etsy is an online marketplace that pretty much connects sellers and buyers. And since the pandemic started, Etsy has seen a huge growth both in its share price and into their business itself. So let's look a little bit about their balance sheet and why it's an interesting stock to buy. At the moment, Etsy is at $207 per share, which is way higher than the 52-week low that was about $61. So you see there has been a huge growth recently into the stock. But it's not at its highest point since then because it has been up to $250 a few months back. So by looking at the chart right here, you can see that Etsy started really growing since March of 2020, so exactly when the pandemic started, because just like Amazon and other online marketplaces, there has been so many people using them because if you don't go to the store anymore, you're gonna go to an online marketplace to buy some stuff. And we can see that it reached a point in about mid-February where Etsy was at its peak, and right now it came back down a little bit from its high, but we're gonna see why Etsy is a good buy right now. They have a market cap of about 26 billion, which is pretty nice, but if you compare it to other marketplaces online, it's actually not the biggest one at all, which is one of the things that made me really interested into this stock because they still have a huge way to grow the business. They also have a PE ratio of about 76, which is not too bad, and an earning per share of 2.69. They also don't actually pay a dividend yet, so if you guys really focus on dividend investing, Etsy might not be the stock for you. But now something interesting about them is that they have a current ratio of assets per liability of 4.17, which is actually pretty great. It means that they have more than 4 times as much assets as liabilities, so they have way more ways of making money than losing it. And if we look at what the experts have to say about Etsy, well, for most of them, Etsy is a buy at the moment, but the price target for it is about $237, which is still quite a bit up from what we are right now. And on a scale from 1 to 5, 1 being a strong buy and 5 being a sell, Etsy is at 1.9, which is a buy at the moment. So if you guys are interested into Etsy, it might be a great opportunity at the moment. What really made me interested into Etsy is that the fact that you can compare the business to Amazon, eBay, Wayfair, and all those huge companies. And if you look at the size of Etsy, as I said before, they still have a huge way to grow. So in my opinion, if you buy Etsy right now and you hold it for the long term, it can really become something even bigger than it is right now. And since we saw a little dip since February of 2021, of course, in my opinion, it's a great time to go into Etsy stock. And now let's go to Palantir. You probably already heard of Palantir before, and I already spoke about it on my channel once when I was doing my entire portfolio reveal that you can go and watch right here if you guys are interested in. But what Palantir actually does in their business is that they work with softwares to help manage, analyze and store and even defend data. It's currently used by many organizations such as the FBI or the CIA, so you know that they have a serious business if they work with these kind of organizations. But it's not it, they also work with other governments. For example, in France, they also use them for the data. Now currently Palantir price is about $23.4, which is a great price in my opinion to get into Palantir. Now if we look at the 52-week range, we can see that Palantir moved quite a bit since the last year. They had lows of about $9 and went up to $45. So really there has been a huge growth into Palantir, like people are starting to get interested into this stock, which is why I'm putting it into this list. They currently have a market cap of $43.9 billion, which, you know, it's a pretty big company already. Now something special with Palantir is that they don't have any PE ratio since they are not profitable yet. Same thing with EPS, you have to be profitable to have an earning per share. And of course, since the company is not profitable, they also don't pay any dividends. Now, just like Etsy, they have a pretty interesting current ratio of assets per liability of 3.74 times, which means that they have 3.7 times more assets than liabilities, which is always a nice thing to have. Now, if we look at the experts and what they have to say about Palantir, well, it's pretty much a different thing that with Etsy, because at the current time, people are mostly saying to hold or to sell Palantir because, well, there was a lot of hype around it and experts don't really like this stock for the simple reason that they are not profitable yet. And as you can see, in January of this year, we actually saw Palantir going up to $40 per share, which is super high. And since at the moment we have about $23 per share, and Palantir is still a growing company that is working with big organizations, so you know they're not gonna fail since these organizations are actually using them. I highly recommend you guys take a look at Palantir. You don't have to buy it or anything, but at least look at what they offer as a business. They are securing data, storing it, and analyzing it, which in my opinion is a really important thing to do, and that's a technology that pretty much anyone will need at some point. And as I said before, since now we have about $23 per share on Palantir, I would say it's a great time to buy in and get into Palantir stock. Now, of course, be careful with this one since it's not a profitable company yet, and that might be scary for a lot of you guys, which I completely understand. If you don't feel comfortable buying into a company that is not profitable yet, it's completely fine, and let's continue with the others on the list. Next one on the list, also one of my holdings that I believe is a great time to buy in, that's EXPI World Holding. EXPI is a real estate company that at the moment is completely changing the real estate world by having a more online approach to real estate. In my opinion, it's an underrated company for sure, and I'm going to explain you why right now. So what EXPI pretty much does in real estate is that they created an online real estate agency. And if you guys don't know anything about real estate and how it works, well, when you are a real estate agent and you want to, well, just do real estate, have some deals, make money, sell homes and all that stuff, you need to be part of an agency so that you then have a name behind the company so people can trust you, and this agency will take commissions every single time you sell a home. But what happens right now with XPI is that they took this agency and put it online, which means that if you use them, your commissions will be way lower, so then you make more money and they still make money out of you. So it pretty much makes sense for anybody being into real estate to use EXPI since you will then make more money after all. The current price is about $37, which is pretty nice, but if you compare to where it was a few months back, I really believe that right now is a great time to go in. Their 52 weeks range is absolutely amazing. It went from $4 to $90 per share. So you clearly see that there has been a lot of interest on EXPI recently. And if we look at the chart right now, you can clearly see that EXPI has been growing since the middle of 2020 until January of 2021 when EXPI started getting traction because CNBC started talking about it and Wall Street also started being more interested into what they were doing. And you can then see that the stock spiked up to like $90 per share, which is absolutely awesome. I bought into the stock first when it was at $21. I sold a bit at this point, but then you can see that the stock price went down quite a bit, and right now we are at about $37 per share, which, as I said before, in my opinion is an amazing time to go into XPI stock. They have a really small market cap of $5.2 billion, which is also something great about this company, which means that they are going to grow quite a bit in the future. The current PE ratio is about 175, which is a little bit too high in my opinion, and the current earning per share is about $0.21. Now, XPI, just like the others on this list, don't pay any dividends. And when it comes to the current ratio of XPI, they have a 2.2 ratio of assets per liability, which is also pretty nice. But now what's really interesting is that if we look at the experts and what they have to say about the XPI, their current price target for this year is about $71. And remember, right now we have about $37 per share. In my opinion, it's a strong buy at the moment. EXPI has a lot of potential, and if you hold it for the long term, this might be an amazing stock to own. I really believe that over time, EXPI is going to take control of the entire real estate world by having just an online platform that can then help real estate brokers, agents, and pretty much anyone make more money. So that's why EXPI is on this list. Let's now speak about Carnival Corporation, which is a cruise line. CCL mostly operates in California, and they own many ships around the world. For example, in New Zealand and Australia, they also have some ships over there, but most of the cruise ships are actually in the USA, in California. So why am I speaking about CCL on this list? Well, in my opinion, it's a really interesting stock. I remember owning Carnival Cruise stock when the stock price was about $18, but currently the stock price is about $27. The 52-week range is pretty interesting. They went from $11 to $30. But what makes it the most interesting in my opinion with this 52-week range is that they've been hit super hard with the pandemic, and they are still recovering from their lows. And just by looking at at the 2-year chart, you can actually tell that CCL has been hit so hard that they went from $55 to $11 in just a few weeks. But since March of 2020, they have been recovering slowly but surely up to now $27. So why is this stock on this list? Well, first of all, Carnival Cruise is the leader when it comes to cruise ships, and I would not really bet on any other cruise line at the moment, because since the others are all smaller than CCL, they have more chances of actually going bankrupt, since at the moment cruises cannot operate at all since the pandemic started. They have a market cap of 32.4 billion, which makes them, as I said before, the biggest cruise line in the world. They don't have any more PE ratio, since right now they are losing money since the pandemic started, but before they had one. And their earning per share is at the moment negative $13. They also don't pay any dividend, and they have a current ratio of about 1.45 times assets per liabilities, which is fine and could be a little bit better in my opinion. Now, if we look at what experts have to say on CCL, their price target is about $27, so that's exactly where we are at the moment. But mostly what's interesting about CCL is that since the vaccines are now available to everybody, well, of course, the population is going to start being more immune to the pandemic, and right now I really believe that in the next months, cruises will be able to operate again. That's why I believe that buying CCL right now is a good thing to do, because when everything will start reopening, we'll see CCL stock price going up quite a bit. So it's kind of a recovery stock, and if you guys are scared of this kind of stocks, it's completely fair. You don't have to go into CCL if you want to be a little bit more on the safe side. But in my opinion, since CCL has been a super successful stock in the years before COVID happened, well, of course I believe that right now it's a good time to go into the stock and wait for a few years for it to come back to where it was before. Now finally, for the last on this list, I'm gonna speak not about a stock but about an ETF that in my opinion is interesting at the moment. This ETF is called OGIG. So why do I recommend buying OGIG as an ETF? And if you guys don't know what an ETF is, well, first of all, it's a regroupment of multiple stocks into one holding, and if you buy this holding, you buy into all these shares. So it's a great way to diversify, and it's a safer way to invest your money than just mutual funds. So OGIG is pretty much following the internet giants, which in my opinion is a really great way to see a great return with a safer approach to investing. Some of the biggest holdings are Alibaba, Amazon, Facebook, Microsoft, Google, Snapchat, Zoom, and you know all these companies pretty much. They also have some Chinese companies that are also growing super fast. And if you look at the past performance of this ETF, you can see that it's up more than 100% just from last year. So if you guys are interested into all these companies that are the big tech sector companies, some that are pretty much a monopoly pretty much in every single sector, well, this ETF is really interesting because you can invest into all these companies at once by just buying one share of the OGIG ETF. Now, something interesting also with OGIG is that they have an expense ratio of about 0.48%. And if you guys don't know anything about expense ratio, it's pretty much the amount of the percentage of money that you're gonna have to pay every single year by holding OGIG. And this money is directly going into O shares ETFs and the management of it. So the people that are working on this ETF, that are weighing all the companies inside, that are choosing the companies to put inside this ETF, this is paying for them. Now 0.48% of an expense ratio is not the best. We've seen way better. For example, with Vanguard, you can have expense ratios that are like 0.05%, which is really nice. But for this ETF, since it's a little bit more risky and the companies that are inside are way more volatile, that's why they have a little bit of a bigger expense ratio. Now, if you compare it to, for example, ARK Investing, their ETF is about 0.75%. So there are bigger and smaller expense ratios for every single ETF. This one is pretty much in the middle. And well, with what they offer, I really believe that this expense ratio is not a problem, since it's a pretty good sector in which you can invest with all these companies. So that's why I recommend OGIG as an ETF for the last stock to pick. And if you're new here, my name is Alexi, and here on this channel I speak about personal finance and how you can make, invest and enjoy your money. And if you guys are interested into this kind of content where I speak about stocks, how to make money, how to invest your money and all that stuff, you can just subscribe to the channel. That would mean the world to me. Also like this video and go watch one of these two videos right here that can help you out. I really hope you enjoyed, and I can't wait to see you next time.